Our government has been clear. It's time to build, and we're making generational investments to build things right here at home.
Canada just reported economic growth, but here is the shock. The country did not grow by producing more, earning more, or spending more. It grew by cutting itself off from the United States, and that should deeply worry Washington. On paper, this appears to be a clean rebound, but beneath that single number lies a far more serious and unsettling reality. This growth did not come from confident consumers or expanding businesses. It came from a sudden and historic collapse in imports, especially goods coming from the United States, driven by tariffs, trade friction, and a quiet shift in behavior across Canadian households and firms. In plain terms, Canada's economy improved not because people felt richer, but because they bought less from America. Household spending declined, government spending pulled back, wages rose unevenly and failed to keep pace with living costs. Yet the growth numbers still turned positive. That is not strength, that is adaptation under pressure. This is no longer just a Canadian story. It is a trade war story with direct consequences for American exporters, American workers, and the future leverage of the United States in global trade. And if this trend continues, the next phase of this trade war will not look like a negotiation or a headline dispute. It will look like a structural break, one that quietly strips the United States of leverage it has relied on for decades. Stay with us to the very end, because the final consequence is not just economic, it is a shock that Washington has not planned for and may not be able to reverse. When the quarterly breakdown is examined line by line, the scale of the shift becomes impossible to ignore. In the 2025, Canada's real gross domestic product rose 0.6% after contracting in the previous quarter. But that entire reversal was driven by one dominant force. Imports fell at their fastest pace since 2022. According to national statistics data, the pullback was broad-based, hitting consumer goods, vehicles, and industrial inputs, with trade flows from the United States declining the most. Exports increased only modestly. Household spending declined again. Government expenditure also moved lower. Under any traditional reading, those signals point to an economy under strain, not one accelerating. Yet the arithmetic of national accounts turned restraint into growth, because the subtraction from imports was larger than the loss in domestic demand. Wages tell a similar story. Average compensation rose roughly 1.1% quarter to quarter, but the gains were uneven. British Columbia recorded growth of just 0.2%, while stronger increases were concentrated in smaller, resource-driven regions. Corporate income rose approximately 2.5%, largely fueled by energy, mining, and financial institutions, sectors that employ fewer workers and distribute gains unevenly. This is not a cyclical rebound. It is an adjustment under pressure. And the most dangerous consequence of this shift is not visible yet in consumer prices or employment data. It is building quietly inside supply chains and trade relationships where, once broken, the damage does not announce itself until it is already locked in. Away from headline growth figures, the lived reality inside Canadian households tells a far less optimistic story. During the same quarter that gross domestic product turned positive, household consumption declined again. This was not driven by a sudden preference for saving or a surge in confidence. It reflected caution, affordability pressure, and uncertainty about income stability. Spending on durable goods weakened most clearly. Purchases of vehicles slowed sharply. Discretionary retail softened. Inventory accumulation declined as households and businesses avoided tying up cash. These patterns are consistent with an economy bracing itself rather than expanding. Rising prices, especially for food, housing, and energy, continued to erode purchasing power even as nominal wages increased modestly. Compensation data reinforces this divide. Average wages increased by roughly 1.1% quarter over quarter, but that figure masks severe regional inequality. In British Columbia, one of the country's most expensive provinces, wage growth barely registered at 0.2%. In contrast, stronger gains were concentrated in smaller, resource-focused regions such as the Northern Territories and parts of Atlantic Canada. These increases often reflect project-based activity or public sector support, not broad labor market strength. For many households, the result is a paradox. Official growth exists, yet financial security does not improve. Mortgage costs remain elevated, rent inflation persists. Groceries consume a larger share of income. The decision to buy less from abroad is not always ideological. In many cases, it is a forced adjustment driven by price sensitivity and risk avoidance. This matters because consumption is not just an economic input, it is a confidence signal. When households pull back simultaneously across regions and income brackets, it suggests fear of future instability. That fear is incompatible with a durable expansion. Instead, it points toward an economy that is reallocating under constraint, not flourishing through opportunity. And when households adjust this way, the consequences rarely stop at the border. Reduced demand does not disappear. It shifts, contracts, or vanishes entirely, with ripple effects that eventually reach producers, exporters, and workers beyond Canada itself. At the corporate level, the picture looks deceptively stronger. Aggregate corporate income rose by approximately 2.5% in the same quarter. Energy producers benefited from higher global prices. Mining firms gained from renewed demand for critical materials. Financial institutions posted improved margins as interest rate dynamics continued to favor balance sheets. On paper, this creates the appearance of resilience. Profits are rising, equity markets respond positively, headlines suggest adaptation rather than distress. But this layer of strength is narrow, concentrated, and misleading. These sectors are capital intensive and employ a limited share of the workforce. Gains accrue primarily to shareholders and executive compensation, not to broad wage growth. The transmission mechanism from corporate profit to household relief remains weak. As a result, inequality deepens even as macro indicators stabilize. This divergence has implications beyond domestic politics. When profits rise while consumption falls, firms adjust strategy. Investment decisions become defensive. Expansion plans are delayed. Supply chains are redesigned to minimize exposure to trade, friction, and tariffs. Over time, these choices reshape trade flows in ways that gross domestic product figures cannot immediately capture. For exporters in the United States, this is where the warning lights begin to flash. Canadian firms reducing imports do not simply pause orders, they reconfigure procurement, they sign new contracts. They invest in alternative suppliers across Europe and the Asia-Pacific region. Once these networks mature, reversing them becomes costly and politically difficult. What begins as a household-level reaction to higher prices and uncertainty evolves into a corporate-level realignment with long-lasting consequences. And this is the point where trade war dynamics stop being temporary and start becoming structural. The most dangerous phase is not when tariffs are announced or retaliated against. It is when businesses quietly assume that friction is permanent and plan accordingly. By the time the damage becomes visible in employment data or export volumes, the strategic shift is already complete. And in the next section, we will examine how this quiet realignment inside Canada collides directly with the United States economy itself in a way that threatens growth, labor markets, and long-term trade leverage far more than any headline tariff ever could. From Washington's perspective, the Canadian adjustment initially appears manageable. Headline forecasts for the United States still project economic expansion into 2025. Aggregate output is expected to grow modestly, financial markets remain supported, and corporate earnings in several sectors continue to outperform. But beneath those surface indicators, the pressure created by tariffs and shifting trade behavior is building in ways that are far more destabilizing than headline growth suggests. American exporters are the first to feel it. Canada remains the largest single export destination for the United States, absorbing hundreds of billions of dollars in goods each year across agriculture, manufacturing, energy, and consumer products. When Canadian imports contract, the impact does not spread evenly. It concentrates quickly in regions already vulnerable to employment volatility. Midwest manufacturing hubs, agricultural producers, automotive suppliers, and cross-border logistics operators are disproportionately exposed. Tariffs amplify this effect. When trade costs rise, exporters lose competitiveness even before volumes decline. Margins narrow, contracts are renegotiated or abandoned. Smaller firms, which lack the capital to absorb higher costs, are forced to retreat first. Over time, this creates a hollowing effect where only the largest corporations can maintain cross-border presence, while regional suppliers lose access altogether. At the same time, inflationary pressure inside the United States remains stubborn. Tariffs function as a tax on imported goods. Those costs feed directly into consumer prices and industrial inputs. This leaves the Federal Reserve trapped between conflicting mandates, cutting interest rates to support employment risks, reigniting price pressures, maintaining restrictive policy to fight inflation risks, slowing growth further, and weakening labor markets. This policy tension is not theoretical. Public scenario analysis from major financial institutions has already outlined the risks. Higher tariffs combined with reduced migration and labor force growth lead to a materially smaller economy over time. Demographics amplify trade policy mistakes. Fewer workers mean less consumption, less innovation, and slower recovery from shocks. What makes this moment particularly dangerous is timing. The United States is attempting to assert trade leverage at the same moment when partners are actively building alternatives. Once those alternatives are viable, leverage erodes rapidly. Tariffs stop functioning as negotiation tools and begin functioning as accelerants of disengagement. And disengagement, once normalized, is extraordinarily difficult to reverse. Internationally, the reaction has been pragmatic rather than ideological. Canada has not framed its shift as confrontation, it has framed it as diversification. Trade agreements are expanded, supply chains are widened, exposure to any single partner is reduced. From a risk management perspective, this is rational behavior. European suppliers have increased presence in Canadian markets. Asia-Pacific partners have gained incremental share in manufactured inputs and consumer goods. Energy and critical minerals are redirected toward buyers seeking long-term stability rather than short-term price advantage. None of this requires public announcements or political theater. It unfolds contract by contract, investment by investment. For the United States, this is the most challenging form of competition. It does not generate dramatic headlines. There is no single moment of rupture. Instead, market share declines quietly. Influence fades gradually. And by the time concern reaches the policy level, the economic reality has already shifted. Global firms respond similarly. Multinational corporations reduce dependence on cross-border North American supply chains vulnerable to tariff escalation. Redundancy becomes strategy. Resilience replaces efficiency. While this protects balance sheets, it also raises costs and lowers overall productivity. Global growth slows and fragmentation increases. The irony is that this environment benefits only a narrow set of actors. Resource extractors, logistics platforms, and large technology firms capable of navigating complexity gain advantage. Small and medium-sized enterprises lose access. Workers face instability. Consumers pay more and choose less. For allies observing this transition, the lesson is clear. Reliance on a single dominant market carries risk. Trade war dynamics transform reliability into vulnerability. As a result, diversification is no longer optional. It is a strategic necessity. And this is where the United States faces its most serious challenge. Not retaliation, not recession, but relevance. In a world where partners quietly re-engineer trade relationships, the cost of exclusion compounds year after year. What looks today like a temporary adjustment could become tomorrow's permanent reordering. And in the next section, we will examine how this trajectory leads toward a long-term strategic twist that fundamentally alters who holds power in global trade and who no longer does. One of the most unsettling signals in the current cycle is the widening gap between consumer behavior and consumer confidence. While households in both Canada and the United States report elevated anxiety about prices, employment stability, and the future, spending patterns tell a different story. Online retail reached record levels during the latest holiday season, with total digital sales exceeding $11 billion in a single weekend, representing year-over-year growth approaching 10%. At first glance, this appears to contradict the narrative of restraint. But the composition of that spending reveals a deeper truth. Physical retail traffic weakened. In-store sales grew at a fraction of the pace seen online. Consumers did not spend more because they felt secure. They spent differently because technology allowed them to stretch shrinking budgets further. Artificial intelligence-driven shopping tools now dominate the retail experience. Automated price comparison, personalized discounts, and algorithmic deal targeting push digital traffic increases of more than 800% compared to previous periods. This is not a signal of abundance. It is a signal of optimization under pressure. Every purchase is calculated, every dollar is scrutinized. This pattern mirrors what economists observed during periods of acute stress in past cycles. Spending does not disappear. It becomes more strategic, more defensive, and more concentrated in channels that promise efficiency. The result is an economy that appears vibrant in aggregate, but feels increasingly fragile at the individual level. For trade dynamics, this shift matters enormously. Tariffs raise baseline prices. Artificial intelligence tools help consumers partially offset that increase, but only by reducing margins elsewhere. Retailers absorb losses. Suppliers are squeezed. Smaller producers are pushed out entirely. What looks like resilience is often redistribution under constraint. As these forces interact, the economy begins to hollow from the middle. Consumption persists, but stability erodes. Growth continues, but trust does not. And when trust breaks, the next adjustment is rarely gradual. Financial markets reflect a similarly distorted reality. Equity indices remain elevated. Technology platforms, logistics firms, financial institutions, and energy producers continue to post strong performance. These are the companies best positioned to navigate fragmentation, volatility, and complexity. They profit from scale, infrastructure control, and pricing power. Yet beneath this surface strength lies a troubling divergence. Labor-intensive sectors struggle. Brick-and-mortar retailers contract. Manufacturing employment remains vulnerable. Small businesses face higher input costs, tighter credit conditions, and reduced pricing flexibility. The gains of the current cycle are increasingly concentrated both geographically and socially. This concentration is not incidental. Trade war conditions accelerate it. Tariffs favor firms large enough to absorb shocks or reroute supply chains. Smaller competitors lack that flexibility. Over time, market power consolidates. Innovation slows. Wage growth decouples further from productivity. For policymakers, this creates a dangerous illusion. Rising markets suggest success. Positive gross domestic product readings imply momentum. But neither metric captures the erosion of economic resilience. They do not reflect household stress, regional divergence, or long-term competitiveness. The real cost emerges slowly. Communities dependent on cross-border trade lose relevance. Skilled workers exit shrinking sectors. Investment flows toward defensive assets rather than productive expansion. Once this transition sets in, reversing it requires more than policy tweaks. It requires rebuilding trust, predictability, and access. And this is where the paradox becomes inescapable. The tools used to protect domestic industries through tariffs and trade pressure may ultimately undermine the very foundation they are meant to defend. By accelerating fragmentation, they reduce scale. By increasing volatility, they discourage long-term investment. By forcing adaptation, they encourage permanent alternatives. What looks today like a series of isolated adjustments across consumption, technology, and markets is in fact a single structural shift. And it is pushing the global economy toward a point where growth continues, but stability does not. The most important consequence of this shift has not appeared yet in employment reports, inflation data, or trade balances. It will emerge in something far harder to restore once lost: strategic leverage. And in the next section, we will confront the long-term twist that explains why this moment may mark the beginning of a permanent realignment, one that leaves the United States reacting rather than leading. For decades, the United States has relied on a simple assumption in global trade: size equals leverage. As the world's largest consumer market, Washington could apply pressure through tariffs, market access, and regulatory signals, confident that partners would eventually return to the table. That assumption is now under strain. Canada's adjustment reveals why. When trade friction persists long enough, economic actors stop waiting for resolution. They plan for permanence. Businesses do not build supply chains for political cycles. They build them for cost certainty, reliability, and risk reduction. Once tariffs are treated not as temporary bargaining tools, but as structural features, behavior changes fundamentally. Canadian firms are already acting on this logic. Import substitution accelerates. Long-term contracts shift toward non-United States suppliers. Investment decisions prioritize jurisdictions perceived as predictable rather than dominant. This is not retaliation. It is insurance. From a strategic standpoint, this is where leverage quietly erodes. Tariffs only function as tools of influence if the target economy remains dependent. Once dependency declines, tariffs lose potency and begin to backfire. They no longer coerce behavior. They confirm the need to disengage. This dynamic extends beyond Canada. Allies observe these adjustments closely. If a close partner can reduce exposure with limited short-term disruption, others can too. Over time, diversification becomes the default strategy across advanced economies. The result is not a collapse of trade, but a rebalancing away from centralized dominance. At that point, policymakers face an uncomfortable reality. Power that once came from market size must be replaced by something harder to manufacture: trust. The most destabilizing implication of this shift is not slower growth or higher prices, it is the reversal of initiative. In a fragmented trade environment, the United States no longer sets the terms, it reacts to them. When partners diversify successfully, future negotiations change character. Concessions lose urgency, deadlines lose force, retaliation loses impact. The balance of risk shifts away from the initiator of trade pressure and toward the system as a whole. In that environment, leadership requires coordination rather than coercion. This is the strategic twist at the center of the current moment. Trade war tactics designed to strengthen domestic position may instead accelerate a world in which influence is diluted. The United States remains a major economy, but not an indispensable one. That distinction matters enormously over the long term. For workers and households, this translates into slower job creation in export-dependent sectors, greater volatility in prices, and fewer pathways to stable middle-income employment. For businesses, it means higher costs, redundant supply chains, and reduced economies of scale. For policymakers, it means diminished room for error. Once this transition is complete, reversing it is extraordinarily difficult. Trade relationships built on redundancy and diversification do not collapse when tariffs are lifted. They persist because they serve a defensive purpose. The shock absorption they provide becomes too valuable to abandon. This is why the current adjustment matters far beyond a single quarter of gross domestic product data. It marks the point where adaptation crosses into strategy. And when strategy hardens, outcomes become path dependent. The final question is no longer whether the United States can win a trade war. It is whether it can still shape the system in which trade wars no longer determine the outcome. And that question leads directly to the final conclusion, one that forces a reassessment of what economic strength truly means in an era defined by fragmentation rather than integration. The story that began with a modest increase in Canada's gross domestic product ends with a far more consequential lesson for the United States. Growth driven by reduced dependence rather than rising confidence signals a shift in behavior that tariffs and trade pressure were never designed to manage. What appears in the data as adjustment is, in reality, a redefinition of how economic security is pursued in a fragmented global system. For Canada, buying less from America has become a mechanism of insulation. For the United States, it represents something far more troubling: the gradual loss of automatic relevance. In a prolonged trade war, partners do not simply wait for resolution. They adapt, diversify, and move on. Once those alternatives are in place, leverage weakens and influence fades quietly rather than dramatically. This is the hidden risk behind tariffs. They can protect specific industries in the short term, yet undermine long-term leadership if they push allies to engineer permanent exits. When that happens, higher prices, unstable employment, and slower growth become structural features rather than temporary side effects. The central question now confronting Washington is not whether trade pressure can deliver concessions, but whether it is accelerating a world in which the United States no longer defines the rules of trade itself. If this trajectory continues, the most severe consequence of this trade war will not be measured in exports, inflation, or quarterly growth. It will be measured in lost influence, and by the time that realization becomes undeniable, the opportunity to reverse it may already be gone. Subscribe for more fact-based global analysis on trade, tariffs, and the shifting balance between the United States and Canada.